Digital Swordsman here. It's September 14th, 2022. This will be the second video today. I just wanted to comment a bit about the article I recently wrote. I think I put it out on Sunday. Mining investing in okay, I didn't even spell that correctly. Nice. Mining investing in a world of ESG inflation and supply shortages. I've given this a lot of thought. I think about it a lot lately. I mean, we have some big overall themes out there. Obviously, inflation is going up, and that means also cost inflation. So we see a lot of miners putting their mines on care and maintenance, especially junior miners, because their margins are getting squeezed. So if you don't have a stellar high margin operation and you get cost inflation, labor inflation. I mean, in Western Australia, for example, I think labor costs are up like 40% in the last 18 months or so. Last I heard. That's an incredible amount of extra costs. So you know what happened to Noah, for example, with Beedens Creek oxides, which had problems with gold recoveries. The grades weren't as good. I mean, they didn't get the amount of gold they thought they would. So what explains that, I do not know. We just know that they believe that some of the gold, fell through the cracks, etc., because it was oxidized. It was coarse gold, etc., and that's why they also believe that the sulfide ore might be higher grade simply, or they might be able to recover higher grades, etc., because the rock is not all broken up, etc. Anyway, so that's going to lead to cost creep. So obviously it's like when you think about, okay, inflation and ramping energy prices. Okay, energy prices, if you have a large low grade open pit, you're going to be trucking a lot of tons. So that takes a lot of energy to mine that. And ESG, okay, a very large footprint depending on where it is. It's going to be probably harder to permit. So it's like when we think about what might happen in the future or what the current trend is. Okay, ESG has been a focus for quite some time. Inflation is a ongoing problem that has really kicked off in the last, last year or so, since 1.5 years perhaps, and it doesn't look to be going away anytime soon. I mean, if you look at 1970s, there were like 3 big waves of inflation. So inflation spiked and went down, and then spiked again, even higher, went down, and then spiked again. So I mean, there's some people who theorize that that's what's going to happen. So one can just assume that, okay, inflation is not an easily solvable problem because inflation can get sticky, which I think is also one of the things that spooked the market in the CPI report from the US, that I think it was the service sector which had, salary creep higher. And that would basically fix inflation. I mean, it's not going to go away in that case because the wage spiral has already started. So we can assume that that's probably, based on how it happens historically, we could assume that inflation is here to stay for quite some time yet. So in that case, obviously, and if you factor in the energy costs, which are probably not going away anytime soon either, we might have a dip here or there. But we have the mining and oil and gas has underspent on investing for a long time. And that's why we have supply shortages across the board as well. Inventories in a lot of metals are way down. So one could foresee that inflation and price of metals are gonna go higher because there's not enough supply. So I mean, if we get a great big recession or a depression, whatever, base metal supply is gonna probably take a big hit, and that's when gold and silver would pay off in that case, because especially gold is a systemic risk hedge, and that's not really I mean, it's not produced in some part of it goes to industry, but that's not, I mean, that would shine when the system would be crashing, unlike, copper, for example. So anyway, okay, how should we think about this? How does it relate to our investing strategy? Because obviously at the end of the day, we want to get paid the maximum amount of money for a case, let's say. So in that case, knowing all this, what is happening, where we're going, right now it feels pretty obvious that, okay, permitting, etc., is very hard thanks to ESG. Some areas will there's a bunch of mines deposits in the world that many say will never get built. I mean, community issues, other, environmental issues, yada, yada, yada. So it's like, if a junior has permits or a mining lease, etc., I mean, that could be worth its weight in gold. If it has lower footprint, the better, probably easier to permit. Obviously, underground mining would probably be easier as well, because that doesn't, people don't have to look at a big mine all day, and there won't be 40 trucks going by a small village every day and stuff like that. Lower tonnage, obviously, is like less ingredients or reagents and labor as well. So, a high grade, low tonnage deposit, if it's underground, it's like low footprint, doesn't need, big cyanide heap leaches, less labor required, higher margins, so it's more protected against cost inflation, etc., etc. Remote locations, that's a good and bad thing. It's like in the case of Snowline, if Valley turns out to be a monster deposit, it might be a good idea that it's kind of remote because there's no people around there. But obviously infrastructure in that case is going to be, a problem. You have to permit roads, etc. But that will probably not happen anyway first things first. They're going to have a major deposit first for that to become a problem. Yeah, okay, so, and on the topic of higher energy costs, it's like, I know in southern Sweden, the price of electricity right now is multiples of what it is in northern parts of Sweden. So imagine you have a mine in north of Sweden and south of Sweden, identical deposits and all that. But the mine in the north had 25% the energy costs of the mine in the south. All else equal, that would make more money. Perhaps quite a bit more money. Higher margins, so every ounce was more valuable. That could obviously be a big thing. So when I think about that, okay, what jurisdictions or regions or countries would I want to own a mine in, and where would majors want to own a mine? We've seen that Canada is incredibly hot right now. Most of the recent acquisitions, or many of the recent acquisitions, have been majors or mid-tiers buying projects in Canada. First of all, it's a first world country, so you don't expect nationalization to happen there, because that's also one thing. It's like when gold and silver comes to the forefront, when shit hits the fan, when entire nations are near going bankrupt, etc. What typically happens, especially if gold and silver is ramping, is like, how far off is it that some countries nationalize the whole mining sector, or nationalize a gold mine or a silver mine or whatever? I think that's going to be increasingly likely. And we know that, I showed in this article, and I've discussed this before, Thomas Kaplan, the famous Electrum Group billionaire, he has what is called, his friend called it that, the Kaplan doctrine. Basically, Thomas Kaplan has come to the conclusion that given how bad it is out there in the world, gold and silver are the places to be. And when they pay off, meaning that something really bad is going on out there in the world, He wants maximum leverage to that, which is through the mining equities. That's why he's a big shareholder of Nova Gold, which owns the huge 40 million ounce Donlin Creek deposit in Alaska. Anyway, he wants to own assets in, I think he said North America. I think that's, yeah, I think he said Mexico, Canada, the US, and Australia. So that I mean, he's thinking from the end. When gold and silver really pays off, where will I get the most leverage? That would be in gold equities. And where would I be able to keep the fruits of that leverage? That is, in his opinion, probably going to be America, where it's like the private property law is like, I mean, that's what the US has been all about. And probably Canada as well. I mean, just thinking out loud, they have a huge resource sector. They produce more than they need, so it doesn't really make sense, I think, from a strategic standpoint to nationalize all that, because it's not, some of it will at least not be, absolutely critical for Canada itself, because that's going to be exported anyway. And Western Australia, especially, I guess the same could be said. They have a huge, the economy revolves around that. I don't see, it's like, would the state or nation nationalize something that's like, I mean, how is the state going to be able to nationalize that big of a portion of the economy? I don't see that happening. I don't see that happening. So when we think, and his point is that he believes that there's going to be a bubble within a bubble in the tier 1 jurisdictions when shit hits the fan. Let's say that is between, if Felix is right, between 2024 and 2028. That, let's say you see more nationalization and people get even more scared, so everybody's, fleeing from the riskier jurisdictions with like socialist regimes, etc. And let's say, there's that's gonna put a damper on, first of all, metal production. We're already seeing right now gold and silver being drained from the COMEX. So what happens in a world where it's like you can pretty much not even get gold or silver? Well, the next natural step is obviously to get exposure, is to buy the companies. And you might not feel that great buying into a gold miner in, I don't know, Tanzania or something. And you know that a neighboring African country just nationalized their gold mines. So there might be a big crowd fleeing into gold and silver related assets, aka mining companies, when shit hits the fan. And they're going to be the ones that are located where the rule of law still exists, and they are first world countries. And in the case of Canada, perhaps like, where the power is cheap and all of that, and miners actually make money there. Because I don't know how hard it is to be a miner in Southern Europe today with electricity costs, up 500%. I still think that in Canada there's a lot of places where the electricity costs are not that high, and Canada has a huge natural gas and oil endowment and hydropower, etc. So if I thought like an owner, where would I personally want to own something? If I had $1 billion, I would buy something that's in the Western world, because we don't know what's going to happen with the East versus West situation. Maybe some partner up, let's say, with the East, and they say, well, we're not going to sell to the West because China wants these resources and we're friends with China right now. Like we've cut off a lot of Russian exports from going into Europe and the US. So in that case, I would want to have a Western allied place, at least, to be in the Western world, because I'm part of the Western world. Probably not a huge difficulty, taking out money to Sweden, for example, or getting the money out of the country, for example, that there won't be too much in terms of capital controls, yada yada yada. And I would want an area preferably where you can get a mine built and where the rule of law is kind of absolute, especially private property, and hopefully where the electricity prices are low. So I mean, from that sense, one could understand why there appears to be quite an appetite to own projects and mines in Canada, because that kind of fits the description. Nevada, US, I guess that would be the same. Then we also have the water problem. Excuse me. We have the water problem. So California is having a severe drought right now. I mean, Canada has a lot of, I mean, there's lakes everywhere, there's hydropower, so I don't think water is going to be a big issue there. And then one can also, it's like, okay, ESG is probably, I think ESG has peaked, in my opinion. I don't think we can afford it. I mean, yes, we see all the time right now, it's, the heat, the drought, that's climate change, so basically we're going to push even harder on ESG. I don't think we can afford that stance for too much longer. We already see Great Britain lift the ban on fracking. So they're forced to be pragmatic about it, because the electricity prices, energy costs in Great Britain are going through the roof. So they basically have to dial down their ESG ban on fracking because they can't afford that. So that's what I think can happen as well. So there's going to be a lot of changes in the future. But it's, again, I think it's best for us and as investors, which I go through in this article. I mean, you want really to front run as many events as possible. So if you think from the end, it's like what will have happened not only for a specific company, which I think is most important, but if you can add that, if you can add, higher jurisdictional premium. Again, let's say everything. 2028, we have a peak in gold. The world will be shit. We will have a new monetary system, yada yada yada, and we will have east versus west, kinda. Okay, first of all, commodities, obviously. It's like real assets. Okay, that's what we've known for quite some time. That's why I'm only in real assets, because of the supply shortages. Because of the supply shortages. So it's like a mine that can get built is going to get an increase in value. Especially in a place where you would want to own a mine and it doesn't get taken away from you. Especially in a place that is allied with West, I would think, especially since we are mostly from the West, and where energy is not scarce, and where water, etc., is not too scarce either. So, and you have, again, a jurisdictional premium. So when we think from the end, that kind of narrows everything down, because if we're not paying for any of those, we're not paying up for those events really. I mean, yes, there is a jurisdictional premium in Canada and Nevada, I would say, but everything is still quite dirt cheap, and the jurisdictional premium might get even higher in the future. Water might become a bigger issue, so if you have a place where there is water, that's going to go up in value. If permitting keeps being this hard, then maybe there will be an even greater commodity shortage. And in that case, a permitted project will go up in value even more. Because, okay, if it is permitted, it is permitted. Well, I know in Alaska recently a road was basically permitted, and now it's not fully permitted. So, I mean, yes, things can change. But I still think the important point is that if we think from the end and then come back to today, it's like the more favorable events we front run, the higher our future expected returns are gonna be. But everything is from a case to case basis. I'm looking at some African developers, etc. They look quite. I mean, they look cheap as hell. Let's just put it like that. I mean, Montage Gold looks cheap. Nucor, I haven't looked at that in quite some time, but I know a lot of people like it. That looks cheap. So basically, I mean, you can buy. It's way easier to buy cheap stuff in Africa than in Canada. Today. But at the same time, it's like, yes, it is cheaper, but in the end, we don't know if that's going to appear cheap. Or that, Canada will get even more expensive because it actually increases in perceived value even more, and actual value perhaps. We don't know that. But I still think it's important to think about, it's like, I mean, worst case scenario, you find something, it's huge, you ride it all the way to the top when it stops growing really, because it's grown so big, and then it gets nationalized. That is obviously a nightmare scenario. But at the same time, in that case, in that scenario, the companies you own that does not get nationalized are probably going to go even higher in value, because nationalization would be a signal or a sign that things were going really bad in the world. So that's also why I'm not against diversification right now. And I do think that from this point to 2028, if you own 30 juniors or whatever, robust, solid juniors, if I don't know, out of those 30, maybe 8 made it, but maybe they make it big time due to all the things we discussed here. Let's say from this point, next 6 years, they go up 2,000%. That might more than pay for all the others that actually literally get nationalized or go to zero, whatever. That's how I think about it. And obviously I think an important thing might be, it's like, okay, this is the Canada's list of critical metals. It's probably going to be easier to get permits, especially when, we realize we can't afford this ESG ban on almost everything going forward. So maybe it will be easier to get, the Patriot Battery Metals, the lithium project, that's in Canada, I think. I mean, I would think that's a good thing in this case. Maybe they get, quicker permitting because it's deemed as a critical metal. And nickel as well, and copper. So it's like, I think that's a good idea as well too. It's like, I don't know how big of a part that's going to play, but if you can, well, it doesn't hurt to think about that stuff. And it's like, global production of critical raw metals. I mean, you can see it's like, this is Russia. PGM's obviously big. SC, scandium, vanadium, and China has, almost monopoly on a bunch of stuff. So it's like, let's say they're, the East versus West thing intensifies, and China basically cuts off supply in some or more metals to the Western world. Obviously, these elements in that case would go up in value in the West. Is that something to bank on? No, but it doesn't hurt really to consider some of this, I think. Again, front running the ever changing state of affairs in the world. So I mean, if you would put a filter, it's like, okay, if you think from the end, or at least given the trends we're seeing right now, okay, I'm concentrated in pretty much the Western world. North America, Europe, but Europe is, I mean, that's not too many mines that get built in Europe, so that would be like Finland, Sweden, and Norway, basically Scandinavia, the Nordic countries. Here there is actually room for mines, etc., because it's not as densely populated as some areas here. And in north of Sweden, for example, there is very cheap hydropower. And then we have Australia, which is obviously a Western world country, first world country. Western Australia, especially a huge metal endowment, a lot of mining. I don't see that getting nationalized anytime soon. The US, where it's like, the country of the Statue of Liberty and where property, I mean, it's pretty much, I mean, it's pretty obvious it's going more socialized by the day. But still, I think there's like Nevada, I mean, mining there is like, that is their state pride basically. So I don't see that going away anytime soon. And Canada, just a vast, vast country, sparsely populated, huge metal endowment. I don't think they can nationalize their sectors either. Maybe a specific metal or something, but I don't see that happening either because, I mean, it is the little brother of the US, so they're pretty strict, I think, on property rights, etc. So okay, if we think about from that perspective, then we add on, let's say, a filter of electricity costs. I don't know what the electricity costs or energy costs are in Australia and where the direction is for those costs, but I assume, I mean, they have coal, etc. At least. Nuclear power could obviously be built anywhere, but it's still going to take some time. So in that case, I would think that's like, if you factor in water as well, I would think that Canada is indeed the top country when you factor in the, challenges from a world of ESG. First world country, huge metal endowment, sparsely populated, Western world laws, relatively cheap power, quite abundant, I think, in terms of water, etc., etc. So again, it kind of makes sense when you look at where the major mining companies have been, doing acquisitions. I have a list. Here, for example, what do the majors put focus on? Some of the most recent transactions that I can recall. GT Gold bought by Newmont, that's BC Canada. Pretium bought by Newcrest, BC Canada. Great Bear bought by Kinross, Ontario, Canada. Kirkland bought by Agnico Eagle, that's Canada and Australia. Battle North bought by Evolution Mining. Core bought the Silvertip mine in 2017, that's in, I think that's Yukon. So I mean, these are different, and you can see Barrick is not included here, but you can see it's like this is one of the first slides when it comes to like exploration in the current Barrick deck. Canada, building a robust portfolio in a favorable jurisdiction. Yeah, so it's like Canada. Okay, obviously, I mean, there were rumors that Barrick had a bid in or thought about bidding on Great Bear as well. But it's pretty obvious that the major miners have voted with their feet and their sights seem to be set on Canada. I mean, they all want apparently to have operations in Canada. They think that's where they're going to get the most value out of their projects, obviously. So again, it's like for investors knowing that not only might we see a flood of investors coming to tier 1 jurisdictions in the future as things get worse and worse, we know also that the potential purchasers, I mean, most of the time it's just trading sardine scheme basically, because 99.9% of juniors will not get acquired. So then you have to, I mean, you have to hope that some investor or speculator bids up your stocks and then you can sell that to them. But if you want to have a shot, best shot, I guess, of actually being acquired and having a natural exit, it would also be Canada, because the potential purchasers seem to be interested in and focused on Canada. So that's, again, one thing to, I think, keep in mind to stack odds in our favor. And you can see the premiums right now. I mean, Newmont here, PE of 11, 17, 42, 18, 19. Newmont is typically, North America, Australia focused. And then you have Barrick with like 8.2, 17, 16, 14, 15. Okay, not a big difference, but it's like, yeah, it appears that Newmont has a higher valuation because of the jurisdictions they're in. Kinross complaining a bit about America's focus not reflected in valuation. So again, they're saying basically, hey, we should get a higher valuation because, especially now that they bought Great Bear. I mean, we have, increased our asset base in Canada in this case, which is the Americas. Newcrest Mining, they have, searching for next tier 1 deposit. You could find obviously a tier 1 deposit in many places in the world, but they have like, they have like 4 areas, exploration target areas. That's the Great Basin. That's Idaho, Nevada, etc. Carlin Trend and stuff like that. And they recently did a deal with Headwater Gold, which has projects in Oregon, Nevada, and I think Idaho as well. And you can see, they don't list it here. Hunting for high-grade epithermal gold deposits through capture of emerging third-party opportunities. That's basically Headwater. I don't know if they've done a deal with another junior, but again, they're voting with their feet. And what is Headwater about? I mean, if we go back to the ESG trend, I've spoken to Headwater. I own Headwater. They are a sponsor. The goal from the beginning was to think from them. They want low footprint, low tonnage, high grade deposits in a tier 1 jurisdiction, especially at least in a tier 1 country. So obviously Newcrest agrees with them because they made a deal for 4 of their projects. So that's very fascinating to see that it's already paying off. That Newcrest, and they talk like Newcrest, yeah, we see what you see. We want low footprint, potentially high margin, let's say underground deposits. Maybe not strictly underground deposit, but it's like, yes, they're thinking from that end as well. And then you have Southern Andes. I guess that's mostly for copper. But it's like you can see this stuff percolating through with the majors as well, obviously. And that probably has been for quite some time, given that they started acquiring projects in Canada, for some years now, since a few years. So if we think about that and we know that when you look at Crescat, for example, they have a huge North America focus, especially Canada. So it's like, I think, Quinton is very well aware of that. He has friends at major mining companies. So, they're kind of front running. They want the big next discoveries, the big deposits to be preferably located in Canada because that's where the purchasers want to be, potential purchasers, and where if you believe Thomas Kaplan, that's also where one of the jurisdictions which is going to go into a bubble within a bubble as shit hits the fan. So it's like anything we can do to stack the odds in our favor. Anything to do, because risk is risk. There's different types of risk, but geological risk doesn't care about jurisdiction, etc. But so if we take the same amount of geological risk, we prefer obviously to have the upside stacked in our favor, because if there's a 50% chance of finding a 5 million ounce, or let's say a 10% chance of finding a 5 million ounce deposit, that 10% chance is the same regardless of where it is, but the upside in case lightning strikes, it's going to be probably way higher in some jurisdictions. So that skews the risk reward a lot. And let's add the fact that maybe they have some permits, maybe they're close to water, maybe they're close to a power station, maybe they're close to skilled labor, etc., etc. All that adds up, especially for an acquirer. Because everything at the end of the day comes down to economics, even though that's not going to be knowable in like 10 years in most cases. But all we can do is like think from the end, front run the future today, and set us up for the best possible risk reward scenarios in each case. That's all. If I mentioned any companies, assume I own them, assume I'm sponsored by them, and assume I'm biased with everything I say. Do your own due diligence, make up your own mind, and this is not investing advice. Have a great day and hit the thumbs up button if you like it, and comment if there's something you want to ask. Bye.